Welcome to Leveraging Supply Chain Finance to Optimize Value. My name is Alex, and I will be your operator for today's call. At this time, all participants are in a listen-only mode. Please note that this call is being recorded. I will now turn the call over to Brad Peterson. You may begin.
Thank you, Alex. My name is Brad Peterson, and I would like to welcome all of you to today's webinar. We at the Mayer Brown Business and Technology Sourcing Group have introduced this webinar series to provide you with timely briefings on key topics when you work on sourcing transactions. Our goal is to provide you with practical and strategic advice to help you in entering into, governing, renegotiating, and exiting those transactions. Today's program, the seventh in our series, is titled Leveraging Supply Chain Finance to Optimize Value. This program discusses solutions to one of the most common contentious issues in sourcing and supply chain arrangements, where a customer, often with good credit, seeks to extend payment terms and thus puts a financing burden on suppliers with a higher cost of capital. Earlier topics in this series have included current critical issues in sourcing, NSA data collection and its impact on cloud and outsourcing, technology dispute resolution, aligning incentives through contract terms, ERP implementation, and contracting for cloud for financial institutions. If you'd like to listen to any of those past programs, please visit the Business and Technology Sourcing Events page on www.mayerbrown.com. I have two administrative matters, and then we'll get started. The first is, during today's presentation, you will be provided with an alphanumeric code. If you are applying for CLA credit, you will need to record this code on the virtual sign-in sheet that you received by email with the connection details that brought you to this call. You will then find directions for returning that virtual sign-in sheet on that form. We will read the code in the middle of the presentation and then again at the end. We plan to include time at the end of the program for questions. And if you'd like to submit a question electronically, please use the question and answer panel on the WebEx screen. If we don't get to your question during this webinar, we will make every attempt to follow up with you after this program. This program is being recorded, as we normally do with these webinars. In a day or so, we will send you an email with a link which you can use to listen to the webinar again or to share with your colleagues. The recording will also be posted to our website. I'm pleased now to introduce today's speakers, Dave Ciancuillo and Massimo Capretta. Dave is a partner in Mayer Brown's Chicago office who practices banking law with an emphasis on securitization, asset-based lending, trade and supply chain finance, and other structured finance products. He regularly represents banks, borrowers, investment vehicles, and other finance companies in various transactions. Massimo is counsel in Mayer Brown's Chicago office and also a member of the banking and finance practice. His transactional practice focuses on representing both financial institutions and companies across a broad spectrum of domestic and international financing transactions. Let's get started.
Thank you, Brad. This is Massimo Capretta. And first of all, thank you very much for letting us take the time to present to the audience. We really appreciate it. Before we get started and covering the topic, I have a couple of introductory items, which I think will be applicable to everyone. First of all, this is a basic presentation. If you happen to be on the call and you are a banker or a corporate treasury person who deals with these items all the time, this might be a decent refresher, but we're not really going to get into the kind of nitty-gritty detail that you might be interested in. However, on September 16th, if you happen to be in the New York area, we're running a program, a half-day program at our New York offices that's going to be more of an industry program with some panels from outside guests that'll probably also be interesting to you. There's some information at the end of the presentation on that, and if you're on our mailing list, you'll receive an invite actually in the next couple of days. Secondly, before we start, I do have one sort of overall item because it happens a lot in this area. We're going to use a lot of terms, and a lot of those terms may or may not be familiar to you, and you may have you may use completely different terms to mean the exact same thing that we're going to talk about. The reason that happens is that given sort of the inherent sort of international nature of this type of product, and also just some industry conventions, people tend to use a lot of different terms to mean the same thing. And there's really no way for us to avoid that in this presentation. It's actually a struggle for David and me to kind of use the same terms sometimes because we come from different parts of the finance department. But if something sounds confusing or contradictory to something you already know, just assume that there's probably someone else who feels the same way. Call us if you have any questions. We're happy to describe anything in more detail. Finally, the last point, the entire slide deck is going to talk about receivables or accounts receivables or trade receivables. I understand that in the language of most of the people on this call, you deal with trade payables, and unfortunately, well, I guess intentionally, we left the term receivables because that's sort of what's used in the industry, and it's what's used in all the documents that you'll see. But we understand that, you know, from your perspective, they're payables. When the term shows up in the slides, just assume that we're talking about payables. It'll make things a lot easier. All right, so to start, on the slide deck now is the agenda we're going to cover. We're going to have a brief discussion of what supply chain finance is, some typical structures, some purchasing price issues. We'll have a few slides on some typical documentation, and then we'll round it out at the end with the discussion of some accounting and legal true sale issues. And to get going, I think I pushed this. All right. I'm going to give this a try. All right. Good. So starting on slide 1, I think I really like this slide because I think it really highlights sort of the overall underlying nature of what's going on here. You'll see 2 arrows, one titled Buyer Dynamics and one titled Supplier Dynamics. And really the entire point of the various supply chain and trade finance products out there are sort of to deal with 2, like the inherent conflicting issue that Brad talked about at the beginning of the presentation. I mean, fundamentally, pretty much every buyer we know is trying to lengthen payment terms and wants, you know, payables extended out as far as possible. I have yet to receive a call from somebody who says they want to pay their suppliers faster. On the other hand, you know, almost every buyer that we deal with is in a better credit position and has better liquidity and cash flow than the suppliers that they have. And, you know, extending out these terms, you know, causes a lot of problems for your suppliers, as you know, because a lot of them don't have the cash flow and the liquidity to, you know, not be paid timely. So that really the entire point of these products is to sort of find a way to leverage the buyer's stronger financial position to provide lower cost liquidity to the supplier to get them to agree, you know, to extended payment terms, you know, or vice versa, get them comfortable or get them a way to be paid faster while the buyer is still being able to manage its cash flow more efficiently. And sort of the real underlying point here is that you're trying to come up with ways for the suppliers to be paid without the buyer having to, you know, foot additional costs, or at least to do it in an efficient way. So moving to the next slide, you know, basically kind of to rehash what I just said, but the key benefits to the buyer to all of these types of programs are that the buyer does get to have longer payment terms. If you happen to work in Treasury and not in purchasing, this is a great vehicle to allow you to provide your relationship banks or financing sources with an income stream without increasing your own direct costs. You know, there are a lot of financial players out there who want exposure to a lot of our clients or a lot of the people on the phone call. But, you know, you may not have any particular needs at any particular time to borrow more money or to do financial transactions of one kind or another. And this is a good way for your bank group or your lender community to get exposure to you and to increase their credit exposure to the company without you actually having to do anything. Obviously, it improves buyer cash flow efficiency. That's why these products exist. The benefits for the supplier are basically that they get their money. You can have your extended payment terms, and the supplier can still be paid relatively quickly. The real benefit for the supplier is that by utilizing these types of programs, the supplier gets to have a much lower net cost than traditional financing. Because you're essentially using the credit of the buyer to finance these transactions, it's usually much cheaper for the supplier to enter into this type of arrangement than to go out and get a loan itself, a working capital line from a bank, or to engage in some sort of asset-based loan or some other kind of transaction that's based purely on their own credit. It's not always the case, but it's usually the case. So moving to the next slide, we're going to have a couple of slides talking about sort of the basic structures out there and the different types of programs. There's a lot of arrows here, but we tried to come up with some applicable pictures. But on the slide, the factory is the vendor, the supplier. The building is the buyer. Of course, you're in purchasing, so I'm sure you work in a building. And the bank looks like a bank. And the first type of program we're going to talk about is sort of the traditional receivables-based supply chain platform. Some people might call this a structured vendor payable program. There are a lot of other terms. And it kind of has, 3 or 4 key features. First of all, and really if you follow the transaction flow, I think it'll make some sense. Basically, the way these programs work is that the buyer, in the normal course, will enter into a purchase agreement for goods and services from a supplier under a regular contract. But the key difference is that there'll be a pre-arrangement in place that kind of anticipates steps 2 through 6. So after the goods and services, the contract is entered into, and the buyer ships the goods and sends an invoice to the buyer, which may be through an electronic platform, and actually in this type of program it always is, or almost always is. The buyer will, acknowledge the receivable or the payable or the bill or the invoice on this platform. And when it does that, essentially, because it's entered into an agreement with the bank on the deck, the buyer will essentially agree that that bill that's been submitted by the vendor is a good invoice, and the buyer will pay it on the date it's due. So essentially, the buyer has entered into a direct agreement with its bank or a buyer of accounts receivable that when that bill is due in 120 days or 60 days or 30 days, the buyer will pay for it, no matter what, notwithstanding any issues with the supplier. That will allow the bank or the financing entity to treat that as an unsecured obligation of the buyer and sort of ignore the supplier altogether. And that's kind of why the magic happens and the bank gets to provide a lower cost of funds, because once the buyer agrees to make the payment, the bank has a direct obligation from the buyer to pay. When that happens, assuming this is all happening online, once again, it doesn't have to, but assuming it does, it'll show up on the supplier screen as a receivable or an invoice that's eligible to be essentially discounted. At the time that that happens, the supplier has an option, which they can choose to elect or not. And if they do, the financial institution will buy that receivable from the supplier for a fixed cost, a negotiated purchase price, and pay the supplier right away. So essentially, the supplier, issued an invoice, say, on day 1, and they might have the ability to be paid on day 3. even though that invoice under or day 5 or whatever, even though that invoice under its normal contract terms isn't payable for 130 days or 120 days or 180 days or 90 or whatever your normal arrangement is with your supplier. That makes the supplier happy because they can get almost all of their money right away, and because they're using your sort of implicit credit to do that, they're going to receive a lot more of their money than they would if they had instead gone to, as I said before, gone to borrow the money from a bank based on a secured lien in that receivable that you're going to pay in 130 days. So essentially what happens is once that arrangement is done, the bank pays the supplier, and at the time that the contract normally requires payment by the buyer pays the bank. Moving to the next slide, which is sort of a variation on the same arrangement, and I'm not going to go into it in as much detail because I ate up a bunch of our time on the first slide, but this type of arrangement is what we're calling a negotiable instrument-based supply chain platform. Some people might refer to this as forfaiting, which is a term that's common in Europe, or there's some other terms. But the steps in the arrangement are similar. The one difference is that when the supplier issues an invoice to the buyer, instead of eventually selling a receivable or an account receivable or an open book payment obligation to the bank, what the buyer issues is essentially a promissory note or a bill of exchange or another piece of negotiable paper that gets sold to the bank. The reason these programs exist is that they tend to be very popular in South America, in certain parts of Europe, because it permits this obligation to be converted into an instrument that can be traded freely. So there's no more, you don't have to worry about some inherent issues that you have to deal with the sale of accounts receivable that don't exist in the United States but do exist in a lot of other countries. The primary risks are the risk of double selling. So, it's difficult in some places to prove that the supplier hasn't sold that same obligation to someone else instead of the bank. And also, there's some issues with priority and some other restrictions on transfer that make that product attractive in some other jurisdictions. And we do see it a bit in the United States, but it tends to be more popular overseas. The one thing about this type of platform and type of product is, I guess, two things. One, it involves the transfer of physical paper. So it's possible to do this without an online platform. Sometimes this gets done physically with the transfer of notes that tends to become cumbersome if you've got a large supplier base. It can be done online. We have clients, and we've worked with clients, I guess, on both sides who have platforms that do this same kind of thing using a platform. That gets a little complicated, so it's sort of beyond the scope of this presentation. But the key thing to remember with this is that there is, there is a real instrument out there that exists that has to be dealt with. Otherwise, it works very similarly. Moving to the next slide, there's a slide here called Non-Recourse Receivables Purchase, and there's a parenthetical called factoring. We actually went back and forth a little bit on whether we wanted to use that term because most of our clients who engage in this type of transaction would not call it factoring. But the difference in this type of product is that it tends to be the involvement of the buyer, if you're dealing with payables, tends to be much less. Really, it's fundamentally a transaction between a financial institution and a supplier. So in one sense, it's much easier to do this transaction. In another sense, there are a lot more, the financial institution entering into the arrangement. It's more difficult for them to do, so there are additional deliverables and steps, which sometimes complicates things. But from your perspective, why would you be using or encountering this product? you would be encountering it either if you are a supplier and you're selling goods to someone and you're considering doing something like this, or to the extent we see this sometimes with some of our smaller clients, they don't want to implement a large-scale platform across their vendor base. They might bring in a bank or somebody to do a lot of sort of one-off transactions with their suppliers, trying to kind of provide the same kind of liquidity. Really, the steps in this kind of transaction, as they're described on the slide, are a little simpler. Basically, once the supplier ships goods and sends an invoice to the buyer, the supplier can request that the bank buy that invoice or that receivable. The bank will buy it in a, quote, true sale transaction. They'll pay a purchase price, and then at some point, at the maturity date, the buyer will once again pay wherever the invoice instructs the buyer to pay. Some of this stuff is happening across your vendor base, and you probably don't know about it because there's no requirement here, you'll notice, that the buyer even be told. So, you know, a lot of your vendors might be engaging in these types of transactions, and you just don't know about it because you're continuing to pay your invoices at the bank account where they told you to pay. You just may not know that that bank account where you're paying may or may not be anymore a bank account of your vendor. It may be a bank account that's controlled by a large bank, and they're taking your payments because they've already paid the vendor for them long before you pay. So moving to the next slide, this is a sort of a summary slide of the three types of programs that I just went over, and you know, kind of comparing and contrasting. And to kind of go through it quickly, you know, the first program we talked about is an invoice-based supply chain program. The second one was a negotiable instrument-based supply chain program, and the third was a non-recourse receivables purchase. You know, as I said previously, the first type of supply chain program tends to be used more in the United States, the second elsewhere. In terms of who's involved, for the first type of program, there are always three parties. It's always the buyer, the supplier, and the bank or the financier. For the second type of program, it's kind of a mixed bag. It depends. The third type of program, there's really only two parties involved. The buyer doesn't really get involved very much. The governing law, if you're a lawyer on the phone call, is generally, for the first type of program, is Article 9 of the Uniform Commercial Code. You may or may not be aware that the way that the Uniform Commercial Code deals with the pledge of a lien over an account receivable and the sale of an account receivable is actually almost identical. So the same law applies. So if you've worked on a receivables financing transaction or a loan, asset-based loan, the applicable law is going to be very similar, even though you're doing something that's substantively different. The second type of program we talked about, and this is sort of the real difference, it's generally not governed by Article 9 of the Uniform Commercial Code. It's governed by Article 3, which, you know, thinking back to law school, if you're a lawyer and you're on the phone, you know, like I did, you probably covered this in about 3 hours in a Uniform Commercial Code class once, because a lot of stuff that's developed over the years, especially in Article 9, has sort of supplanted Article 3. But as I said, in other jurisdictions, that's not the case. So that, to the extent you have a U.S. transaction, that's the applicable law. In terms of, I'm going to skip through some of this other stuff, but the one thing I do want to mention, and it's maybe not in even the slide, but it dawned on me that we didn't really mention this at the beginning, is that fundamentally what's happening in all of these transactions is that there's a sale of receivables. So, you know, in those slides we talked about previously, with respect to your supplier, what your supplier is doing is they're fundamentally selling your invoice to someone else. So that invoice will disappear right at the time of sale off the supplier's balance sheet, and ideally they'll be paid. So that'll be good because it'll disappear anyway because they're paid. but it will be transferred, you know, onto the books of the person who bought it. They will have legal right to it, and they'll own it. So, you know, they're the people who have the right to collect it against you. Your supplier's kind of out of the picture. And sort of the same way with you, if you're engaging in that third type of transaction and you're selling, or I guess factoring receivables to, you know, a bank, once you do that, the bank owns the payable or the receivable. It kind of comes off of your books. And as we're going to cover on a couple of slides a little bit later, the whole trick to all of these programs is getting all of those receivables not to come off of your own books as the buyer. But we'll cover that in a little while. I think for the next few slides, I'm going to hand it over to my colleague Dave, who's going to cover some of the more sort of documentation and pricing mechanics issues.
Sure. Thanks, Massimo. My name is Dave Ciancuillo. Hello. Thanks, everyone, for joining. Just sort of bringing us all back to square one, you know, Massimo raised, obviously, the point that under the umbrella of supply chain or trade finance, you know, there are many, you know, potentially many different products. You know, some are buyer-focused, as we mentioned. Some are letters of credit, and some are supplier-focused. I think for most of the remainder of the call and this webinar, we're probably going to try to focus primarily on, you know, transactions where the supplier enters into a receivable sale agreement with the bank. And I know Massimo mentioned this early in the call, but we're going to use the word bank, but there are many more players, you know, in this space that provide financing. So you could substitute finance provider for bank. It doesn't necessarily have to be a bank, because the product is obviously something that is interesting to a number of different types of finance providers. So if we think about what the fundamental component here is, you know, in these transactions where a supplier is selling an account receivable to a buyer, to a bank or financial institution, you know, the part that everybody focuses on primarily beyond what the legal structure requires in terms of true sale is the purchase price. Now, the purchase price is fairly straightforward. It is, in effect, a calculation that determines the time value of money. It's a discount based on the time value of money. The buyer is expected to pay within a certain period of time. The bank or finance company is going to provide financing much earlier than that, and the bank or finance company is therefore going to purchase at a discount from the supplier, and the supplier will generally be happy to take that discount as a result of getting its money much more quickly. So the typical calculation is, you know, the net invoice balance of the underlying receivable itself multiplied by some discount factor. Now, the formula that we have on this page is a little bit oversimplified. You know, it really, you know, is 1 minus the discount rate would be multiplied by the net invoice balance to come up with, you know, something like 98% of the net invoice balance, which would reflect the overall purchase price for the receivable itself. Now, what goes into that calculation? And the typical calculation of the discount rate is generally something based on LIBOR plus a margin. And that margin is a factor based primarily on the amount that the bank wants to pay, as well as the credit risk of the buyer, rather than anything relating to the credit risk of the supplier. Because, again, at the end of the day, you know, this transaction, you know, if structured correctly and properly, will release that receivable from any potential credit risk of the supplier. Massimo, do you want to switch to the next slide?
Oh, sure.
And that one's probably one that you want to take,
yeah.
Payment platform?
Yeah, so we're going to have a few slides here on sort of the typical documentation that you would encounter. I'm going to go back in the slide deck a little bit. The first transaction that we discussed, the receivables-based supply chain platform, the next few slides are going to cover sort of the typical documents you would see and the terms. But as Dave said at the last slide, other than this one item that we're going to talk about here, the rest of the documents would be the same, whether you're doing a supply chain type platform or you're just doing a receivables purchase facility. The real difference is this document. So starting off, there'll typically be two or three main documents in these types of arrangements. The first is something we're calling a paying services agreement. That's not a magic term. People use all kinds of terms. But it's essentially, going back to the slide, and I'm sorry I keep doing this, it's the line that runs from the bank to the buyer. So this is an agreement that's between the bank and the buyer, and essentially it says that the buyer will agree to confirm the amount, payment due date, invoice number, and other information of each supplier invoice. That's critical for the bank, as I mentioned before, because of the stuff I'm going to get to right next. Two, the buyer acknowledges that each supplier can sell the buyer invoices to the bank at a discount in exchange for early payment. That you're going to find that in every agreement. I mean, that's sort of implicit to what's going on, but it'll still show up. Three, the buyer will acknowledge that if the receivable is sold to the bank, the obligation of the buyer to pay the bank is, and here's the magic words, absolute and unconditional, without any claim, abatement, deduction, reduction, or set-off of any kind. What that means is that you're agreeing that no matter what happens between you and the supplier, you will pay the bank on that invoice. Now, that doesn't mean that you can't go back and ask for offsets, deductions, sue your supplier, do whatever you want, but what it does mean is that you're still going to be paying your vendor, your bank or financier on the due date, and then you're going to have to worry about that with your supplier. I mean, typically the way that gets handled is offsets on future bills. Because what will happen is the next invoice will be confirmed for a lesser amount. You know, the finance company doesn't care. The bank doesn't care. All they care about is that they're funding what is actually payable. They don't care whether it actually represents the agreed purchase price in the contract. And four, there'll be a lot of technical procedures in these types of agreements, and this is where we're really happy we have people like Brad around. But they'll govern, you know, the technical aspects of the bank and the buyer interfacing. You know, there'll be provisions for use of the bank's platform. There might be some licensing type stuff, and it really just some data protection. It really just depends on, you know, the sensitivity points of the individual bank, but that part will actually be the majority of this type of agreement. And you know, it's important. I mean, I really should stress that for us, sometimes we overlook this. And of course, Brad, I diminished you to a single bullet point, but this really is the majority of the document, and it's really important to have that work okay. Also, I guess that's it for that document. I'm going to hand it over to Dave, who's going to cover the next couple of slides on some of the other documentation.
Great, thanks, Massimo. Okay, so now we're looking at, again, the agreement between the supplier and the bank. The traditional form of this agreement is in the form of a purchase agreement or a receivables purchase agreement. They're often called limited recourse purchase agreements. We use the term here that you'll see in the second bullet point of this particular page, which says non-recourse. That's not entirely true. It's actually limited recourse, and we'll get into that in a little bit. These transactions and these programs are generally designed as uncommitted facilities. There are regulatory reasons for that make the transactions less expensive for both parties. Some people might say, well, how can the supplier get comfortable without having a commitment? It's so typical for parties to have committed facilities that they can rely on. Part of the answer to that is simply what's become customary as part of these programs. Suppliers understand that the finance providers aren't going to make money if the finance providers don't purchase receivables when offered, to the extent that those receivables happen to be eligible. But nonetheless, they're designed to be typically uncommitted, although there are some situations where certain suppliers ask for a committed facility because that's important to them.
But
Sure.
And I wanted to throw in, Dave, I think the big thing is that, you know, if you're rolling out one of these programs, I mean, the uncommitted nature of it, I mean, a lot of times it's not as critical to the supplier because, frankly, if you're extending their payment terms and they don't really have a choice, they're in no worse a position than they would be if we didn't offer this program to them. So essentially, you know, you know,
That's right.
98% certainty that the bank will buy the receivable is better than 0% certainty that they're going to be, or 100% certainty they'll be paid in 120 days.
Right, that's right. Other than the fact that obviously it creates a much shorter time frame in terms of when they actually get paid. If, however, a particular supplier requests that a facility be committed, it becomes more expensive. There's typically a commitment fee associated with that, and the documents become more complicated, obviously, because from the bank's perspective or the finance provider's perspective, you at this point need to be very cognizant of building in features that will allow you to actually break your commitment if necessary. And you know, the typical language for that I'm sure will be familiar to everybody is you would have an events of default section, and you would have a much more robust conditions to funding section that would be keyed primarily off whether or not certain events existed or certain events of default or unmatured events of default may have occurred. It becomes more complicated as a result of that fact, but again, that happens sometimes, although the vast majority, I think, of these types of transactions are generally speaking on an uncommitted basis. The feature of these transactions, therefore, that makes them work from the perspective of the finance provider or the bank being comfortable that they don't have to factor in the credit risk of the supplier is the fact that the sale is designed to be a true sale from a bankruptcy perspective, so that, and in fact that's explicitly stated, you know, this is intended to be a true sale, the character of the transaction is a true sale. We're going to get into what that means a little bit later from a bankruptcy perspective, but the fact that it's limited recourse to the supplier is a key feature that helps the transaction, you know, be a true sale from a bankruptcy perspective. When I say limited recourse, what I mean is the most important factor in determining that the sale is a true sale is whether or not the credit risk of the buyer, the bankruptcy risk, for example, of the buyer, is something that would generate recourse back to the supplier. And that's, you know, that's typically a non-starter for these transactions. The bank or finance provider will agree that they have no recourse back to the supplier to the extent that the buyer becomes the subject of an insolvency event. Now, why it's called limited recourse is because there are forms of recourse that will allow the bank or finance provider to have recourse back to the supplier. These are specific repurchase events or indemnities that the supplier will provide in the event that there is a dispute or a disagreement or an offset between the supplier and the buyer as a result of the fact that the buyer, for example, might claim that the goods it purchased were defective. The next procedure here on this list is the online platform. Massimo talked about that earlier. You know, often these programs are built on an online platform that will allow the buyer and supplier to affect transactions in a very efficient manner simply by, you know, clicking certain buttons in terms of whether or not particular receivables are approved. And I think the last one on the prior slide, Massimo, was purchase price mechanics. We did talk about purchase price mechanics earlier. Again, it's a time value of money determination. It's one of the most important features of the transaction from an economic point of view, obviously. And, you know, the calculations, therefore, are generally straightforward, although they can become complicated to the extent that, and very often, these receivables purchase facilities will be designed not simply for the supplier to be able to sell the receivables of one single buyer, but oftentimes many buyers under the same receivables purchase facility, and there may be different discount rates for different buyers. And then I think we already talked about the limited indemnification and repurchase mechanics.
Yeah, and I think the one clarification I think we should probably say is that on that last point is that, you know, if you're a buyer and you're rolling out this thing across your vendor base, it would not be the case that the bank would be purchasing receivables from anyone else as part of that program. That would be specific to you. I think what Dave's trying to say and what with respect to a program where you're factoring and you're the supplier, you do have the ability to, you know, of course, sell receivables from multiple customers. But that would apply in a case where, like sort of that third slide where we had, where, you know, the buyer's kind of out of the picture. If you're dealing with sort of this or this, that's going to be rolled out across, you know, really the ultimate customer is you, the buyer. So the bank is going to be rolling that out across your vendor base, but they're not, those facilities and that payment system isn't going to apply to anyone else other than you and your own vendors. That's all I had.
Right. I think that's right. Again, it's important to be aware that there are a number of different types of transactions that can be structured under the umbrella of what people typically refer to as supply chain or trade finance. And you know, each one will be customized for the particular relationship that's being entered into. The one we're talking about here, you know, is a supplier-based transaction, but clearly, as Massimo pointed out, in a buyer-based transaction, or where the buyer initiates the transaction and introduces the bank to its supplier, that one would be focused primarily on that particular buyer. Here we're talking about a transaction that's initiated by the supplier, and the supplier may have multiple buyers that it wishes to offer as part of the facility. Additional features to these transactions, again, remember, there's limited recourse. That means, in effect, that although the bank is taking the risk of buyer insolvency, they're really structured so that the bank is not taking any other risk for taxes, for example, for losses, you know, for third-party claims, you know, in the event that the products that are sold are somehow defective and result in third-party claims, and somebody says, well, now that the bank owns the receivable, hey, there's a good deep pocket that I'm gonna you know, bring a lawsuit against. You know, all of those items, those extraneous items, would be something for which the bank would have recourse and/or an indemnity to the supplier. As a result of that fact, since some of the suppliers tend to be subsidiaries of larger corporations, right, the manufacturing arm of a larger corporation, that supplier, that subsidiary of a larger corporation, may be the seller under the receivables purchase agreement, but the bank may want to know that the indemnities and the repurchase obligations are supported by somebody higher up in the food chain. And as a result, parent guarantees are not unusual in these transactions where you have a financial parent with deep pockets, even if that parent may be, you know, somewhere overseas.
Well, and kind of on the same point, you know, if you're the buyer, and we see this a lot because, I mean, it's sort of the trend now, you know, if you're concentrating all of your purchasing somewhere else, so in Singapore or Ireland or somewhere, and you have an entity that's not particularly creditworthy, you know, it's not uncommon when you enter into these programs for, you know, the bank to require a guarantee from the actual parent company that has the assets and the cash flow. I mean, a lot of our clients don't really care because, you know, 5 years ago, that purchasing entity would have been them anyway. But so you see it sort of on both sides.
Now, of course, you know, sometimes in some jurisdictions outside of the U.S., although a parent guarantee, meaning, you know, an irrevocable payment obligation in the form of a guarantee is very typical in U.S. transactions as well as Western European transactions. There are some jurisdictions you'll find where it's uncommon or unlikely that you'll get an actual, quote, guarantee from the parent company. You know, in many places in Asia, the best you're going to get is a comfort letter. You know, that doesn't necessarily amount to something that's enforceable, rather, you know, sort of a hope and a dream that the parent will actually step in for the benefit of its subsidiary. Participation agreements next on the list, not unusual for a bank, especially if there are large buyers with large dollar amounts. The supplier is selling big, bulky receivables and a lot of them, so the transaction is large. For the bank or the finance company to look for ways to lay off some of the risk. You know, you could call this a risk sharing or a risk participation agreement as well. The underlying receivables purchase agreement is generally designed to be flexible in terms of how the finance provider offloads some risks and generally allows free assignability through participation agreements, you know, without, you know, really even the supplier having an understanding or any sort of an intimate knowledge or relationship with the people who end up being the participants, and they don't really care usually because they know that the bank is really the one that they're facing. You know, their relationship is with the bank, and the bank is the one that they're facing. Again, even though it may not be a committed facility, that's the only person that they have to deal with. Now, it may get more complicated, and sometimes does get more complicated when the supplier wants to restrict who the bank may transfer risk participations to. For example, and I'm sure everybody on this call has heard this or dealt with this before, the supplier may say, look, I have some competitors and real competitors that I don't want having a look at the receivables that I have, because I don't want them to know who my customers are, and I don't want them to know what the invoice amounts and payment terms are. And so they may limit who the bank, can sell participations to. That becomes, again, a more involved and complicated negotiation, but we do it pretty regularly. As Massimo notes here, often blind to the buyer. That's certainly true in a supplier transaction. The buyer is 2 steps removed from the risk participation. It's worth noting here, and maybe flip to the next page.
Sorry.
That's not maybe stay on that last page. All right. It is worth noting here that there are 2 types of transactions, relating to or features to the transactions relating to the receivables purchase agreement between the supplier and the bank. In many cases, the supplier, and again, I know that this call we've been sort of going back and forth between a buyer-centric program and a supplier-centric program, where everybody or many people on this call may be looking at this from the perspective of the buyer. In the context of a supplier transaction where the bank's relationship is primarily with the supplier, very often the supplier doesn't want its buyers to know that it's sold the receivables. Now, this is for a couple of reasons. One is because it doesn't want to lose control of the relationship with its buyer, and it doesn't want its buyer to get an uncomfortable feeling that possibly the supplier doesn't have the financial wherewithal to continue to serve its needs. So sometimes these transactions are set up so that the buyer is notified up front, and many times they are set up so that the buyer has no knowledge that the receivable is being transferred. And in the U.S., that works. There are provisions in the Uniform Commercial Code that protect us in those circumstances. In other jurisdictions, it may be more difficult. I know we're running out of time, so let's go on to the next slide. So I'll make this pretty quick, and I know this particular page is a buyer-centric page, and it's talking about a situation where the buyer, as Massimo pointed out earlier, if it enters into a relationship with the bank where the bank agrees to pay the receivable and the buyer then irrevocably obligates itself to pay the bank at some point later, there are questions about accounting treatment and whether or not the payable may be recharacterized as debt to the bank. That's often, again, a complicated subject that requires special consideration and discussion with the accountants. In the case of accounting from the perspective of a supplier transaction, very often, not always, but very often, the true sale nature of the transaction from a bankruptcy perspective helps to achieve an additional goal, which is an accounting goal on the part of the supplier to get off balance sheet treatment with respect to those receivables. I think we can flip because I guess we're sort of running out of time a little bit. Why don't we skip that, because I think we talked about that before. Again, typical documentation in these transactions, as we talked about, receivables purchase agreement, parent performance guarantee. UCC financing statement, as Massimo pointed out earlier, is very critical, and sometimes parties may not appreciate the fact that the sale of a receivable is treated equally as a collateral assignment of the receivable under the UCC, and therefore filing financing statements is critical in the context of a receivable sale. Payment domination really is a cash management issue. Where is the money going? Are the account debtors, quote, buyers, being directed to make payments directly to the bank that financed the receivable, or are those receivables still going into a supplier account and then redirected into the bank's account? Okay, so off-balance sheet treatment, as we were talking about, generally under paragraph 9 of FAS 166 requires 3 items. And this is true with FAS 166 as it had been with prior iterations of the treatment of the transfer of financial assets. But the first element is legal isolation. What does that mean? Legal isolation is, in effect, that you've transferred the assets in a way that they will not become the subject of the bankruptcy estate of the supplier in the event that the supplier becomes insolvent. How do accountants get comfortable with that? The typical rule for accountants is to look at a true sale opinion. Some law firm will deliver a bankruptcy opinion that the structure of the transaction was properly designed in a way that allows that law firm to opine that the transfer is legally isolated from the supplier's bankruptcy estate in the event of a bankruptcy. That means it won't be called back into the estate. It won't it won't be subject to the automatic stay. So those are things that help accountants get comfortable with one of the features of off-balance sheet treatment from an accounting perspective are satisfied. Second, free assignability. That means the buyer can transfer the receivable however it wants. There are some nuances to free assignability under the accounting rules, meaning free assignability can have limitations, meaning the supplier can say, well, you can't sell that receivable or transfer it outright without my consent, but as long as that consent cannot be unreasonably withheld, that generally gets the accountants comfortable. And then no effective control primarily means that the supplier can't go to the bank and say, you know what, I know I sold you that receivable, but I want to buy it back. Sometimes they call that a rope or a removal of accounts provision. As long as the supplier does not have that kind of control, the accountants, if the other two elements are satisfied, will generally be comfortable treating the transfer of those financial assets, the accounts in this case, as off-balance sheet from an accounting perspective.
We have 2 minutes because we have a bunch of questions, so you have to...
Okay, bankruptcy, true sale is and can be very complicated under the U.S. bankruptcy rules. The opinions are often dinosaurs, 60 pages long, that go through a lot of reasoning. But at the end of the day, the analysis from a legal bankruptcy perspective is whether or not the supplier has transferred the benefits of ownership and the risk of loss, and that turns in very large part on whether or not there is recourse to the supplier, meaning if the account debtor or the buyer becomes insolvent, the bank or finance company does not have recourse in those circumstances. Some recourse is okay from a bankruptcy perspective, but credit recourse is a big no-no. And if the collections on the receivable are greater than anybody expected, the supplier does not get any surplus as a result of collections being greater than expected. In those circumstances, and obviously it's far more complicated, but we don't have a lot of time, those situations will generally allow a law firm to give a bankruptcy opinion that the assets have been legally isolated.
All right. We've had a couple of questions, so we do want to address those before we get off. The first one actually was on accounting. So going back to, I guess the right slide is, excuse me, this one. We've had a question on accounting from the buyer perspective, because we did kind of glance through this very quickly. A key part of when you're rolling out a program out to your vendors is that, if you're a purchasing person, the key thing that's internally the most difficult thing to get this to work is that you need to have a lot of cooperation between you, Treasury, and your auditing function, because there's a sort of a real issue here in that these programs are specifically designed to make it so that when these receivables are sold to the bank, they don't get converted as short-term debt on the balance sheet of the company. And that's really important almost always for every company because, obviously your Treasury group will tell you that your ratios and your credit agreements with your banks are keyed off of financial metrics, and if you add a whole bunch of debt, that'll throw off, pretty much a lot of stuff that'll be really bad. So unfortunately, there's not a lot of there's not a lot of accounting guidance on this. It's all sort of tertiary based on some SEC guidance and some materials from the auditing firms, but really the kind of negative factors to avoid, and that are on the slide, this is what somebody was asking about, and they're sort of here, and they're not set in stone because as part of implementing one of these programs, it's really important to kind of get these pre-cleared with your internal auditors and maybe your external auditors. But the factors that show up here are kind of the key things people look at. Is the obligation owed to the bank different than the obligation owed to the supplier? Are you requiring all suppliers to participate on a mandatory basis in this program, or is it optional? Is the buyer involved in negotiations between the bank and the suppliers? Generally, the answer is no. So once you implement one of these programs, the banks will go out and buy these receivables independent of you, and it's usually a good factor if that's the case and you're not intimately involved. Do you have control over the program, or is it really a negotiation between your vendor and the bank? And do you have, and this is really an issue that gets difficult. Are you agreeing to, sort of quote, make it all okay for the supplier if they participate in the program? And that's usually tends to be a very negative factor, and you do want it to be an arm's length arrangement. The second question we've had, this is actually kind of a good one. A lot of the slides you talk about banks. We have a lot of cash. Is it possible for us to set up a program like this without the bank or using our own money? And the answer is yes. There are some programs out there where you sort of cut out the intermediary and you use one of these platforms to just sort of establish a quick pay discounting program with your vendors. Usually you would enter into an agreement with a platform provider to make that work for you. And I guess the only thing I'll say about that is if you're coming to our presentation in September, one of the things we'll be talking about is both that and sort of a new model that's sort of starting to take off a little bit, I think, of creating a private exchange for accounts payable, where there are a number of banks and a number of companies, and they kind of trade these online, and that sort of a lot of times cuts out your involvement with the bank altogether. So in any case, well, I guess one more question, and it wasn't exactly this, so I'm going to restate it the way I want. But something like, this all sounds great, but this must not work all the time. What goes wrong? And really the number one thing that we'll focus on is, that I want to stress, is that implementing one of these solutions, if you're doing a buyer-based supply chain program, is that the thing that always goes wrong is that there's not good communication between purchasing, accounting, and treasury. That by and large, when we do these programs for companies, buyers, that is the number one thing that takes a long time. It makes it difficult because you really do need to learn how to, or work on communicating on these platforms together, because obviously there's a different person buying the products and confirming the invoices than there is dealing with your financial institutions. That's all I have, Dave.
Well, just to add to that, and without being self-serving, communication with the lawyers too.
Yeah.
It sometimes helps if we know, what the underlying strategic goals are of the overall relationship. Just sometimes. No, it's important to properly document the transactions, but it's important obviously to have the right level of communication, to have the right parties involved from an accounting and legal perspective, as well as Treasury, to make sure that there's a proper handshake and the transaction works overall. And then, of course, obviously for our September event, which you should be seeing on your screen right now, we'll go into more detail about trends, what industry participants are seeing, potential new products within the space, and obviously the fact that we didn't really go into it in detail on this call because we didn't have a lot of time. But these are global transactions as well, and there's many considerations to think about when you've got a transaction involving more than one jurisdiction and potentially more than one currency.
Yeah, and the great thing about these programs is that, and we like to remind people of this, is that they make it much easier to roll out a global solution than trying to, provide some kind of financing or some sort of liquidity for your supplier base on a jurisdiction by jurisdiction basis, through some traditional lending products that become very complex. Contact information is on the deck. I know it'll be distributed to you later anyway, but we're always happy to talk, and we love hearing from BTS clients especially, because we really do like talking to you, so please feel free to call anytime. Thank you.
We will be distributing a recording and a link to the materials by email to you in the next day or two. And for those of you applying for CLA credit, the certificates of attendance will be distributed within 30 days of the program date. Those won't come as quickly as the program link. Please watch for our next webinar invitation coming in the next week or so. And we are anxious to hear your thoughts on what you would like to hear about in the business and technology sourcing space. And if you could send us an email at bts@mayorbrown.com, we will respond with webinars specific to your interests. Thank you, Dave. Thank you, Massimo. This has been a great presentation and very informative.
Ladies and gentlemen, this concludes today's call. Thank you for participating. You may now disconnect.